I recently sold all of my shares of the JP Morgan Nasdaq Equity Premium Income ETF, better known as JEPQ, for what's in my opinion, a better alternative for people looking for better growth prospects. I had been observing JEPQ's performance more closely this year and comparing it to some newer, similar ETFs that now exist. And as I regularly like to remind people on my channel, there are new covered call funds being introduced on a pretty consistent basis nowadays. The high-yield sector has been exploding in popularity in recent years, and fund providers continue to introduce better ETFs all the time. Or in my situation, not necessarily better, but just something else that I was looking for. And so this newer ETF that I used the proceeds from JEPQ to buy has been consistently delivering better share price appreciation than the JP Morgan fund, and has also been providing a comparable yield. The holding that I replaced JEPQ with is the Amplify CWP Growth and Income ETF, which is ticker QDVO. According to the description on its website, it says it's an actively managed ETF that seeks to provide capital appreciation and secondarily, high current income. QDVO consists primarily of large-cap dividend growth stocks and is designed to offer high levels of total return on a risk-adjusted basis. If you watch my channel, you might know that I currently hold another fund by Amplify, which is ticker IDVO. Their CWP International Enhanced Dividend Income ETF serves as the main source of global diversification for my portfolio, and I've been really pleased with it so far. I also used to hold ticker DIVO by the same company, but I replaced that one with another holding some time ago. So in this video, I'm going to talk about why I sold out of JEPQ and picked this fund over it. I'm also going to talk about the reasons why, if you currently hold JEPQ, or if you're considering JEPQ, why you might prefer that fund instead of QDVO. Because as much as I like QDVO now over JEPQ, there are a couple of good reasons why someone might still prefer the JP Morgan fund. So I need to start by saying that there's nothing fundamentally bad about JEPQ. I didn't sell it because I think it's going to fail or even do catastrophically bad. What it came down to was that this ETF just wasn't functioning in the way that I wanted it to. Back when I first bought JEPQ, it was a really excellent grower. So JEPQ was something that I always looked to for growth in my portfolio. As you might be aware, I hold a combination of both dividend growth holdings and high income holdings, and JEPQ was something that I was hoping to get a little more growth out of. It still consistently offers a very high yield, but back when I first bought it and when it was really popular, it was still growing very, very well. And so when I was comparing the features of JEPQ to other similar funds that now exist that offer much better growth and a comparable yield, I realized that there are now better options that exist if you're looking for more aggressive growth in your dividend portfolio. I previously mentioned that this year I'd been disappointed with the returns of both JEPI and JEPQ in 2025, which has been a really great year for the market. When comparing JEPQ to other covered call funds with similar holdings like ticker QQQI for example, JEPQ has been falling behind significantly when looking at total return. That's what got me looking around for an alternative a couple of months ago, of which there were several competitors that weren't around when I first bought JEPQ. In addition to QDVO, another good option that I also considered was the Goldman Sachs Nasdaq 100 ETF, which is ticker JEPQ. This covered call fund has also been doing really well, and I understand why some people would prefer this one. But while it does offer better share price growth, it does come with a lower yield than QDVO. But let's take a closer look at this fund's page on Amplify's website. They provide 3 reasons why income investors should consider holding this ETF. The first is growth and high income potential. Seeking capital appreciation from growth-oriented stocks with high monthly income from option premiums and dividends. This is pretty interesting because most covered call funds claim to prioritize current income over share price growth. QDVO is the first covered call fund that I have ever come across that claims to prioritize capital appreciation over high income. Equity exposure and lower volatility. Covered calls and dividends may help reduce volatility versus the overall market during times of broader base market declines. And active management allows for portfolio manager, CWP, to identify opportunities and risks and act on those decisions in real time. Their website has a really straightforward way of explaining how their stock selection process works. QDVO is not an index covered call fund. They pick investments based upon the following criteria. They start by assembling a portfolio of large-cap growth equities with strong earnings and high cash flow. Then they move on to their sector allocations. Relatively balanced across a variety of gig sectors, with CWP determining which sectors to over and underweight based on various factors. Then they move on to picking securities. Consists of 20 to 40 stocks, which are screened and included based on attributes that they believe are attractive, including earnings growth, cash flow, relative performance, and management team record. Once they've assembled their picks, they then use a tactical covered call strategy. Covered call options are written on individual stocks on a tactical basis and may also be tactically written against broad market indexes. The stock selection process has been faring very well for this ETF. This fund has only been around for a year and 2 weeks, and as of the making of this video, its total return in just a little over 1 year has been 29%. Obviously, it's not going to return 29% every single year, but so far, it's been doing much better than JEPQ in a bull market. I should also mention that as of right now, QDVO only makes up around 2% of my overall portfolio, so it's not a tremendously big investment for me. But why would someone prefer JEPQ over QDVO or even some other alternatives? One of the biggest things that stands out to me with JEPQ is the tax treatment of its dividends. There's some people out there who just do not like to see return of capital make up part of their dividends. Even though ROC doesn't always mean the fund is eating itself up, especially if it uses an option strategy, I still see comments from people who just like to avoid it. The distributions paid by JEPQ are a combination of non-qualified and qualified dividend sources. So JEPQ is still a worthy consideration for people who want to minimize their exposure to ROC if they can. JEPQ is also more diversified. Right now, according to their website, the JP Morgan ETF holds over 100 different positions. QDVO, as we just saw earlier, only has a maximum of 40 positions. So JEPQ is more than twice as diversified compared to the Amplify Fund. Plus, the Amplify Fund doesn't hold those equity-linked notes, which are supposed to provide more stability in share price. But when I was reviewing these factors, none of them stopped me from swapping out the JP Morgan Fund, because I wanted some higher growth in my portfolio. Now let me address a question that I'm sure some people are asking. If you watch my channel, you'll likely know that I already hold QQQI, which is the NEOS Nasdaq 100 covered call ETF. Given how similar QDVO is to QQQI, at least in terms of holdings, why would I hold both ETFs? Well, there's a couple of reasons why I decided to hold both funds. The main reason is, like I've been saying, I view QDVO as being a more growth-oriented investment, whereas QQQI is more of a high-income pick in my portfolio. This was my original intention for holding JEPQ until it started underperforming quite a bit. If we compare share price movements, QDVO does a lot better than the NEOS fund when it comes to capturing upside. Dividend growth also appears to be better for QDVO. But QQQI comes with a much higher yield. The NEOS ETF offers a yield of well over 14.5% pretty consistently, and QDVO typically yields around 9 to 10%. As I like to remind people, when speaking of diversification in a portfolio, I also view diversification when it comes to strategies as part of that. If an ETF holds all or almost all of the same positions as another fund I currently hold, but it uses a different strategy, then I don't mind holding both funds with duplicate positions. If you don't want duplicate holdings but you want growth, then go with QDVO or an alternative like that. If you want higher income, then go with QQQI. It's that easy. But in summary, that's why I made the swap. JEPQ isn't terrible in my opinion, but it stopped providing the same growth that I was looking for when I first bought it. Someone over on Patreon mentioned that they were concerned about the high amount of AI exposure, and if a bubble were to pop, then QDVO could be hurt a lot more than the Nasdaq. I think that is a valid concern, but again, at only 2% of my portfolio, an AI bubble popping wouldn't wreck me, and I would consider swapping right back out of QDVO if that appeared to be happening. But let me know what you think. Do you think QDVO is better, or do you still prefer JEPQ, or even JEPQ, which I know has a lot of fans now? Feel free to leave a comment, but with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.